Hi, this is Chuck Carnevale. And this video is going to look at Microsoft the business versus Microsoft the stock through the lens of FastGraphs, the Fundamentals Analyzer software tool. In a quick orientation to the FastGraph tool here, what I've got plotted here is earnings per share as measured by this orange line. As you can see to the right here, the operating earnings growth rate of Microsoft has been 12.5% since calendar year 1999. In 2003, Microsoft started to pay a dividend, and we illustrate that by the light blue shaded area. In 2005, they paid a $3 special dividend. So by looking at earnings and dividends here, you get a graphic picture of Microsoft the business and how much income it's thrown off to its shareholders. Clearly, Microsoft is a strong company. They've had great earnings growth. They only have a 14% debt to capital ratio. And as I'll show later, they're trading at a very low valuation now. But the point is, the stock has been a horrible performer during this period of time. So let's take a quick look at its performance. Had you invested $1,000 in Microsoft at the end of 12/31/1998, that $1,000 would have actually shrunk to $817.61. Or in other words, your capital would have actually fallen. Now, Microsoft, as I pointed out, did pay a dividend, and they started out at 8 cents a share in 2003. And I want you to notice that dividend has increased every year. But in 2005, they paid a $3 special dividend. But their core dividend went from 8 cents to 16 to 32 to 34, etc. So cumulatively, during this roughly 15-year period, you would have received $224 in dividends on a $1,000 investment, plus your $817 that was left out of your original $1,000, and you would have virtually broke even at $1,041.77. That's 0.3% compounded annual return over a 15-year period, or almost a 15-year period. The same investment in the Standard & Poor's 500, by the way, would have averaged about 2.8%, which is also not that great. But how do you explain the conundrum, if you will, that I've shown in this chart so far? We have a great company that grew earnings at over 12% a year and a lousy stock that has actually lost shareholders. In order to answer the question of how the company has done so well and the stock has done so poorly, we need to bring stock prices into the equation. So let me now add monthly closing stock prices onto this graph. Now the black line is monthly closing stock prices. And as you can see, if you look back at 1999 and 2000, Microsoft's stock price was extremely above this orange earnings justified valuation line. And this line represents a PE ratio of 15 on this graph, as you can see in the color-coded orange box to the right. But like most tech stocks, this was the infamous tech bubble or irrational exuberant period. And what happened when a stock gets this irrationally overvalued, as you can see, all these years Microsoft's stock price was simply trying to move back into alignment with its earnings justified valuation. And as a result, even though the business was doing well and earnings were generally growing, or they certainly increased with the occasional little hiccup along the way, Microsoft's stock price had nowhere to go but down. Finally, by February of 2008, the stock price came into alignment with earnings, and since that time, the stock price has been more functionally related to earnings. Of course, the Great Recession of 2008 caused the stock price to drop. But to put things simply, Microsoft did not suffer from being a bad business. It suffered from being a significantly overvalued stock, and that's also true of a lot of other tech stocks during that time, names like Oracle and Cisco, etc. However, I believe it's quite important that shareholders or prospective investors in Microsoft are not biased by what's happened to the stock over the last 15 years. Because now Microsoft stock is trading below its intrinsic value. It offers a 3.2% dividend yield, only trades at 10 times earnings, has only 14% debt to capital, and I would argue that it has an intrinsic value of approximately 42 by its fiscal year end, which ends in June of 2000. This final line that I've added to the graph is the normal price earnings ratio. It's simply a calculation that FastGraphs does to try to find out how the market has typically priced this stock over this time frame, and we can see that this represents 12.6 times earnings. So anywhere I touch this blue line, my PE is 12.6, and as you can see, the stock has kind of hovered around that. It's actually been even below that since May or June of 2010. So I would argue that by fiscal year end, Microsoft is worth at least 36 at 12 times earnings, has a 3% dividend yield that's expected to continue to grow. So I believe you're looking at an extremely high quality company with strong financial that has a very low valuation, giving you a great margin of safety and a high yield. And the key to this whole article and video is don't let the previous history of the stock price bias you from having an opportunity to invest in a blue chip dividend paying technology stalwart at a very attractive valuation.